Welcome to the Wall Street's crossover show, brought to you by Tip TV in conjunction with our sponsors, Admiral Markets. It gives me great pleasure to welcome Mr. Darren Sinden, market commentator, Admiral Markets. Darren, how the devil are you, sir?
Yeah, very well, thank you, Nick.
It feels like ages since me and you sort of sat here and talked the talk.
Yeah, wasn't it last
couple
Monday?
of weeks?
Or was it Monday before?
Yeah,
Time flies by, doesn't it?
A decent month, October, for the US markets in particular.
Yes, you could be forgiven for forgetting all about the horror show that was August and early September. Yeah, one of the best months for equities since 2009. So yeah, very good. Whether it can continue is obviously the big question. If we don't see a Fed rate rise in December, then we probably will push on, as we said, possibly for the wrong reasons. Remains to be seen how the market would react to a rate rise, so we'll have to wait and see, I guess. But we've got plenty of data coming up this week that may influence that decision. Including
non-farm payroll on Friday.
Absolutely, yeah.
Understood. OK, we've got a number of slides to go through. Let's kick off with data released over the European session. What's caught your attention this morning? OK, well, it really sort of started yesterday, in as much as we got official Chinese PMI data out on Sunday. And then first thing this morning, we had the market flash PMI version. Anyway, the net of all of this is that the PMI data was soft. Manufacturing PMI came in at 48.3. That's the official read. That is better actually than I think the forecast of around 47.2, but obviously still well below the 50 level. Exactly. So we're still seeing contraction. Services have been picking up the slack of late, but even there we saw a slowdown. The read for services PMI coming in at 53.1 and below the forecast of 53.4. So not great news for China. I think we saw what the equity market thought of that in the sell-off in Shanghai today. More PMI data out from the Eurozone and constituent states. So we had manufacturing PMI for the Eurozone came in at 52.3. So that was actually marginally better, perhaps surprisingly, than the forecast of 52. There was a very strong reading from Italy, which I think sort of helped push that over the gain line. Right. But I also note weak readings from France and perhaps a bit disappointingly from Spain as well. But no such issues with our own UK manufacturing PMI. A big surprise to the upside. In fact, it was the best number as far as this measure is concerned for 16 months. So yeah, so another sort of positive feather in Mr. Osborne's cap. And then what to look forward to for the rest of the week. If you're an early bird or a night owl, you could stay up for the Reserve Bank of Australia interest rate decision due very early tomorrow morning around 3:30 a.m. London time. At the end of tomorrow, Mario Draghi will speak around 1900 London time in Europe, an event that the ECB is hosting. So I think the market will be watching for any further clues after he was quoted in the Italian press at the weekend. And then some more key European data as we head into towards the end of the week. Producer price index for September on Wednesday and the retail sales number for September on Thursday. Understood. Let's move on to the European movers this morning. OK. The first one I've picked on here is Hikma Pharmaceuticals here in the UK. That's HIKLN, the ticker there. £20.56, down around 5%. Basically, there's no secret here. This effectively a generics drug maker, and the generics business posted weak numbers, and the company's lowered guidance for this division, and that's disappointed the market. And there we are. And I wouldn't be surprised if we saw a rush of downgrades for those. Understood. And RWE? Yeah, well, the stock that seems to be coming back into favour ever so slowly is RWE GR in Germany, one of Europe's biggest power generators, and there's been a continued positive reaction this morning, probably driven by a certain amount of short covering after the news on Friday that they found partners in finance for the UK's Galloper wind farm, a £1.5 billion deal. This just to put this into context, though, these shares have been the worst performer in Germany over 2015. So whilst they're bouncing today, they've still got a lot of ground to make up over the year as a whole. Understood. Let's turn our attention to M&A, rumours and movers this morning. Well, what I thought I'd do today was just have a look at the stats for October and they weren't good, were they? No, they weren't. No, several last years have been announced in October, but overall the month was one of the weakest for M&A in the last 20 years. It was down. The numbers were down for October by some 40% from the monthly average
from January to the end of September. On the face of it, it all looks quite promising. $514 billion worth of deals were announced in October, and actually it was the fifth biggest month in history in terms of dollar value, according to research from Thomson Reuters. And within that, a couple of large deals, well, particularly large deals, including AB InBev's bid for SAB Miller and Pfizer's early talks to acquire Allergen. But that high dollar value masks the fact that the actual number of underlying deals is much lower on the month at 2,177 versus the 2015 average of 3,521, so sharply down, yeah. And that average calculated between January and September, again by Thomson Reuters. We haven't seen a lower number than that since October 1996, when we saw just 2,066 deals. 2015, however, does remain on track to be probably the all-time record year for deal value, with almost $4 trillion worth of M&A announced so far, and we'll be tilting at the 2007 record, which was 4.3 trillion. October deal numbers may be a sign that the boom is coming to an end, and obviously the M&A boom in 2007 ended for very unpleasant reasons, i.e. the credit crunch and then the subsequent crash.
Understood. Okay, so let's take a look at the US data points to keep an eye on today.
Okay, two numbers that I think are worth watching today: the ISM manufacturing survey and the market manufacturing PMI, effectively two measures of PMI and industrial and economic output. So the ISM forecast to come in at 50.6, below the prior read for September of 50.7. Markets manufacturing PMI, interestingly enough, is shown to come in better at 54 against the prior read of 53.1. So we'll look at that in a moment, actually. And in terms of what's happening later in the week, well, tomorrow we've got factory orders. Thursday, weekly jobless claims, and they take on a heightened importance because, as you already said, on Friday it's non-farm payrolls. And just to reiterate, this is one of only two non-farm payrolls reports
before December.
Before the end, yes, before the meeting, before the end of the year, yeah.
Understood. Okay, so let's turn our attention to US pre-market movers and the chart levels.
Okay, well, a stock that is almost impossible to avoid at the moment is our first name to look at, Valiant Pharmaceuticals. That's ticker VRX in the US, $98.50, up around 5.04% pre-market. But this has been, as I say, splashed all over the headlines in the last week. And the troubled drug maker has rallied pre-market after further allegations on Friday saw the stock fall 15.9%. And the question mark here is it a pyramid scheme? Is there dubious accounting practice? Is it all a house of cards, really, I suppose? Just to flag that the stock was down 47.7% in October. So although it's bounced well today,
still got some work to do.
Caution that there's a lot to for the management to explain and persuade investors to get their faith back in the company.
Understood.
And then DreamWorks, yeah, DreamWorks Animation, which is ticker DWA in the US, $20.24, down 7.75% as of Friday's close. They were downgraded quite sharply by Merrill Lynch, who moved the stock to underperform to neutral, nominated a $16 price target, so well below the current levels. I just flagged this one because media stocks led a wider sell-off at the beginning of August. So you might recall that Disney got slammed then, and then several others followed. So it might just be a sector to keep an eye on over the coming weeks, just to see if there's a trend forming here.
Understood. And
then in terms of levels today, a little bit of divergence in as far as European equities are concerned. We're a bit weaker on the FTSE, so 63.10 plays 63.65 now. Our levels there. The DAX has appreciated today, so 10,000, 815 plays 10,940 there. S&P, we're looking at 2070 on the downside, plays 2095 now to the upside, and for the Dow, 17,660 plays 17,800.
Okay. Currencies,
the euro has appreciated again from Friday night, and 110.04 now our downside level, plays 110.45. There's a little bit of resilience in the Aussie dollar, US dollar, so 71.20 now, plays 71.52 on the upside. Of course, as I said, that rate decision out early tomorrow morning. Dollar yen, it's gone very quiet, really.
Yeah.
It's the football parlance. 120.28 on the downside, plays 120.78 on the upside. And cable took heart from that positive PMI read this morning, so back to 154.40 on the downside, plays 154.90 to the upside.
And that's all about interest rates, obviously.
Yes, indeed.
Okay, so let's move on to the last slide, in focus.
Right.
What are we looking at today?
Well, I think this is really the story for the rest of the year. We're looking at key US data ahead of the Fed's December meeting. It is quite hard to tell exactly what's going on in the US economy at the moment, but the Fed has said that a December rate rise is data dependent.
Yeah.
So today we've got the release of two measures of the health of the industrial portion of the economy, and the ISM Purchasing Managers Index, and the newer version of PMI measure, market flash PMI. And I just wanted to plot the chart here, which shows the ISM, which is which is this line here, both grey, aren't they?
Yeah.
And then the newer market PMI number. Net, there's sharp divergence between the two reads. The ISM number, the more established measure, trending sharply lower over recent times, whilst the market PMI measure is heading higher. So it seems odd to me that there should be such sharp divergence between two measures that are meant to be covering roughly the same ground. I think I'll put more credence on the ISM. I'll stand to be corrected there, but it'll be interesting to see what those numbers show a little bit later on this afternoon, and whether we get any convergence again or further divergence, and from that a clearer picture perhaps of what's going on in the US economy as a whole. Which
I don't think is that clear at the moment.
No, it's not. No, it really isn't. You've got many contradictory factors, and you've also got perhaps the non-farm payrolls taking on maybe an outsized importance, because they're okay as a headline read, but it's data-rich numbers like the ISM, like the Philly Fed, like the New York State manufacturing data that really have the nitty-gritty and the deeper long-term economic impact than the non-farm payrolls.
Darren Sinden, market commentator, Admiral Markets, thank you for your continued support. That wraps up the Wall Street Crossover Show. We'll be back on Friday, 1 p.m. Friday, 1 p.m. for your next Wall Street Crossover Show. Have a good day. Thank you.